In March 2020, while grocery stores ran out of toilet paper and the S&P 500 was collapsing 30% in 3 weeks, someone was buying farmland in Louisiana. Not a farmer. A software engineer from Seattle who'd never touched a tractor. He spent $4.2 million on land he'd never seen in person. He wasn't alone. Between February and May of that year, institutional investors and high net worth individuals quietly acquired over $14 billion worth of agricultural land across the United States. Not farms, not businesses, just land. This wasn't panic. This was a playbook. When markets scream and headlines spiral and everyone's watching their portfolio turn red, there's a specific category of assets that moves in the opposite direction. Not because they're exciting, because they're boring. Not because they promise quick returns, because they promise something wealthier people value more than growth: control. We talk about billionaires buying stocks during crashes, Buffett's famous line about being greedy when others are fearful. That's the story we know. Buy low, sell high, wait for blood in the streets. But that's not the full picture. The real shift happens in asset classes most people never think about. The kind that don't have ticker symbols or daily price updates. The kind you can't buy on Robinhood. And right now, in early 2026, we're watching the same pattern repeat. Uncertainty is back. Inflation cooling but not dead. Interest rates higher than they've been in 15 years. Geopolitical tension that makes supply chains feel fragile. A commercial real estate market that still hasn't recovered. And a stock market that keeps hitting all-time highs while consumer confidence keeps falling. It's the kind of environment where normal investors freeze, where financial advisors say, stay the course and diversify and don't try to time the market, and where a very different group of people start buying things that sound almost quaint. Let's start with the obvious one: farmland. Between 2000 and 2025, the price of agricultural land in the United States has increased an average of 4.3% per year. That doesn't sound like much until you realize it's outpaced inflation, outpaced bonds, and did it with almost zero volatility. Bill Gates now owns more farmland than anyone else in America. 269,000 acres across 18 states, not through a farming company, through a private investment firm called Cascade. He didn't buy it all at once. He bought it steadily, quietly, mostly during periods when traditional assets were unstable. Why farmland? 3 reasons. 1, it's finite. They're not making more of it. 2, it generates actual cash flow, rent from farmers, lease agreements, crop sales. 3, it's disconnected from the stock market. When Tesla drops 20%, corn prices don't care. But farmland is just the entry point. The next layer is water rights. In California, Arizona, and Nevada, water rights are now traded like commodities. In some regions, the right to a single acre-foot of water, about 326,000 gallons, sells for over $10,000. In drought-prone areas, that number doubles. T. Boone Pickens spent years accumulating water rights across the Texas Panhandle, not for farming, not for drinking, as a hedge, as a resource that becomes more valuable the scarcer it gets. Most people don't even know you can own water separately from land, but you can. And the people buying it aren't buying it to use it. They're buying it because in 20 years, it might be worth more than the land itself. Then there's timber. Forest land has become one of the most quietly profitable asset classes of the last 2 decades. Harvard's endowment owns over 200,000 acres of it. Yale's endowment has been buying it since the 1990s, not to cut down trees tomorrow, to hold an asset that grows literally while you sleep. A pine tree increases in value as it matures. You don't have to do anything, it just gets bigger. And when lumber prices spike, like they did in 2021 when they nearly tripled, you have an asset that's suddenly worth exponentially more. The pattern here isn't random, it's deliberate. These are all hard assets, physical, tangible, things you can fence off, things that don't disappear when a bank fails or a currency inflates or a government changes policy. Here's the part that doesn't get explained enough. These assets aren't just stores of value, they're control mechanisms. When you own farmland, you control food production. When you own water rights, you control a resource cities, and corporations will eventually need to negotiate for. When you own timber, you control a supply chain input that can't be replicated or synthesized. This is different from owning shares in a company. Apple can get disrupted. Tesla can lose market share. But corn, water, wood, those don't have competitors. They have substitutes maybe. But no one's innovating their way out of needing food or water. And there's another layer. Tax strategy. Agricultural land qualifies for exemptions that other real estate doesn't. In Texas, if your land is used for farming or ranching, your property taxes can drop by as much as 75%. You don't have to farm it yourself. You just lease it to someone who does. Timber gets even better treatment. When you sell timber, it's often taxed as capital gains, not ordinary income. And if you hold it long enough, you can defer taxes indefinitely through something called a 1031 exchange. You sell timber in Oregon, buy timber in Georgia, and never pay tax on the gain. These aren't loopholes. They're features of the system, written into law decades ago to encourage land conservation and agricultural production. But they work just as well for someone parking $50 million in Washington forest land as they do for a multi-generational family farm. The math is uncomfortable. The less liquid the asset, the more tax-advantaged it becomes. The more essential the resource, the more insulated it is from market crashes. Now compare that to what gets sold to retail investors during uncertain times. Gold, crypto, commodities futures, volatility plays, inverse ETFs. These get marketed as safe havens, as hedges against inflation or recession or systemic collapse. And maybe they are, for traders who know what they're doing. But they're not what the wealthiest people are actually buying. Gold hit an all-time high in late 2024. Everyone talks about it, but institutional ownership of gold as a percentage of total assets has barely moved. It's flat. Meanwhile, institutional ownership of farmland, timberland, and real assets has grown every single year for the past decade. The difference is simple. Gold is a bet. Farmland is a position. One requires you to be right about timing. The other just requires you to be patient. One reacts to fear. The other absorbs it. There's a reason Ray Dalio talks about diversification into uncorrelated assets, but then Bridgewater's actual holdings include forest land in New Zealand and agricultural partnerships in South America. The public advice is generic. The private moves are specific. Let's zoom out. If the wealthiest investors in the world are quietly moving capital into physical, resource-based, control-oriented assets during periods of uncertainty, what does that tell us about what they expect? It tells us they don't trust paper. Not completely, not long-term. They'll still own stocks and bonds and private equity, but those aren't the anchors anymore. The anchors are things that exist whether the financial system works or not. It also tells us something darker. This kind of accumulation creates asymmetry. When a small number of people control large amounts of essential resources, pricing power shifts. If you own enough farmland, you influence food costs. If you own enough water rights, you influence development. If you own enough timber, you influence construction costs. You don't have to actively manipulate anything. You just have to own enough that market forces bend around you. And here's the kicker. Most of these purchases are legal, quiet, and irreversible. Once someone owns the land, it's theirs. Once they own the water rights, those don't expire. Once they own the timber, it keeps growing. There's no mechanism to undo it, no policy that redistributes it, which means the gap between people who own resources and people who need resources gets wider every time there's uncertainty. Every crash, every crisis, every moment when normal investors pull back, someone else steps in and locks up another piece of the physical world. In 2010, the average price of an acre of farmland in Iowa was $4,000. Today, it's over $10,000. In 2010, institutional investors owned roughly 8% of all timberland in the United States. Today, it's closer to 30%. The shift isn't loud, it doesn't make headlines, but it's happening. And the question no one's really answering is this. When the people with the most resources stop betting on markets and start buying the actual things markets depend on, what does that say about where we're headed? Maybe it's just smart diversification. Maybe it's a rational response to volatility. Or maybe it's something simpler. Maybe they know something breaks eventually. And when it does, the people who own the land, the water, and the trees won't be the ones scrambling to figure out what comes next. They'll already be there, waiting.